Imagine you're a recent college grad in your early 20s and you start your career in the mortgage industry. By your early 30s, you're opening up your own mortgage company. And by your early 40s, you have raised $100+ million from the largest Silicon Valley venture capital firm. And you are on a path to create the mortgage company of the 2030s. If you can put yourself in that seat, you can put yourself in the seat of today's special guest, my boss, Dan Snyder. Dan, welcome to the Loan Officer Podcast.
Thank you.
Yeah, I'm excited we get to do this. So I am up in Ohio, which until recently I wasn't willing to actually recognize as a real state. That's a long going inside joke with our fans, but you know, my affection for you and Mike Baines and the executives and everything that we're trying to do at Lower, I'm starting to make that slow turn. But no, I'm up here because we're hosting our annual sales conference, and I get to be a part of it. I get to attend. I have some of my new branch leaders coming up, and I'm excited that I get to share you with our TLOP audience.
I appreciate you having me.
Yes. So
long time overdue.
It is long time overdue. You and I first met actually in Arizona at a Housing Wire event. And for anyone who reads Housing Wire, you'll see Dan quoted and mentioned throughout episodes, articles, weekly, monthly. And then you recently were at the Housing Wire IMB Summit. You spoke there. And today I want people to get to know your story because you have a very unique story because your first job out of college was mortgage, correct?
Yeah. Yep. Wells Fargo.
Very few of us can say that. Like very few of us can say our first job out of college was mortgage. Did you go to college thinking you wanted to do mortgage?
I don't think who thinks about going to mortgage.
Okay. What was your goal?
Problem. I mean, it's such a good industry, and yet though, like at universities, they don't. Not only do they not talk about it, there's not even classes around it.
No. So. That's why we have TLOP. Right, TLOP is very much the shit they don't teach us in school.
That's good.
It's everything you and I learned because we became loan officers. But no, interesting fun fact about Dan Snyder is, you're not that Dan Snyder.
No.
You know, like when I was learning about the company, I was doing my research, and I literally saw that, you know, one of the founders is Dan Snyder. I was like, F that guy. I'm like, there is no way I'm ever going to go be affiliated with a company. And then I did some research. I'm like, oh no. This Dan Snyder is like 2 decades younger and way hipper. I was thinking, obviously, for those that don't follow sports, the
Commanders owner.
Yes, he purchased the Redskins, later became the Commanders. But from what I've read, he doesn't seem like the most respectable type business operator. So I'm happy that you get a chance to change that legacy for the name Dan Snyder.
Yeah, when we first started, what became Lower, we were dual headquartered, Columbus, Ohio, and Columbia, Maryland. And I don't get the Dan Snyder reference ever in Columbus. And yet, though, my co-founders all lived in Columbia, Maryland. And so I'd fly into Baltimore all the time. And probably 50% of the time, the gate agents at the airport would just heckle me. They'd look at my ID and they'd say some derogatory comment about the actual, you know, rich but mean Dan Snyder.
So not you.
Not me, but yeah.
You did grow up in Ohio. You went to Ohio University, right?
Yeah.
And you had aspirations not to become a mortgage lender, but to do what?
Be a lawyer.
Be a lawyer. Like your whole life. That's what you were going to do. Your mom's an attorney.
Yeah.
You were going to be an attorney. What happened?
Well, you know, everything was engineered to be a lawyer. You know, more than likely looking back now, just because it's like something you can tell your parents and friends and you know it sounds good versus a loan officer. And yet though, so I got this job. I graduated with a marketing degree from Ohio University, go Bobcats, and then got a job while I was studying for the LSAT at Wells Fargo Financial, which was, you know, they didn't just sell mortgages, it was credit cards, auto loans, and they hired recent college grads. In fact, the alumni network of Wells Fargo Financial out there is strong and very talented. So I start there, and while I'm studying for the LSAT, you know, I turn out that, you know, I'm just grinding away at the job, cold calling. They'd give you leads, lists, you set up appointments. I was pretty good at it. And ultimately, within like 12 to 14 months, got my first gig as a manager and loved it, fell in love, and then my one buddy was in law school, and I saw what he was doing every day, reading books that were,
Boring.
very boring, very thick, and just like, you know what? And I was making already good money. So I was like, I'm just going to see what this does. And so I was there until it became just too bureaucratic for me.
Okay, so I love where this is going. But before we dive any deeper, we're going to have to take a break. We're going to do a quick word from our sponsors. And if you notice, I'm rocking their t-shirt right now. Open Door, loan officers. Take a listen to why we are partnered with Open Door.
Loan officers, if you're anything like me, you've probably never even thought to partner with Open Door. Well, I'm here to tell you, rethink that thought process. Here's why. How many times have you had a buyer or a borrower wanting to purchase that next home, but they couldn't get an offer accepted because they had to sell their home first and no sellers were willing to accept an offer with a contingency? Open Door has a solution and they're willing to work with your realtor partners. And Open Door is perfect for buyers wanting simplicity and convenience. As long as the home is not already listed in the MLS, they will pay your referring agent a 1% commission when they buy your borrower's home. Open Door's been around for over 10 years and they operate in 50 different markets. So do yourself a favor, do your referral sources a favor, and look to Open Door the next time you have a borrower who needs to get a home sold quickly and conveniently and can't mess with the stress of listing the home for sale in the MLS.
All right, so you're working at Wells Fargo. You're taking a break. Was it like a gap year so you could study for the LSAT? Was it because you graduated early? In your mind, you're thinking, I'm going to work at Wells Fargo. I'm going to make some money. I'm going to study for my LSAT, take my LSAT. Then I'm going to start applying to law school.
Yeah.
And then you had to eventually go tell your mom and dad, hey, look, not going to law school.
Yeah, eventually I did. And they were just like, good parents, not, they weren't judgmental at all. They're like, okay. Plus I was making more than most, I think, lawyers do out of law school at the time. And this wasn't even I wasn't in at Wells Fargo home mortgage. It was a much more of a salary job with bonus structure.
Okay.
It wasn't like it was a get rich job. It was like career path type place. It really built fundamental, not only selling ability, but developing people. That was their big thing. Take a kid out of college, give them the tools, challenge him, give him a career path, and then let's see if they can cut it. And if they can cut it, they have a great career. And that's kind of what I did. And that's how I ultimately, brought with me down the line.
Yeah, because you're doing that in your early 20s. And then to fast forward, you get into your early to mid 30s, and then you find yourself running mortgage for a small bank out of Maryland. It was the bank out of Maryland that you were doing this with?
Yeah. So I had met my co-founder.
That's Mike Baines, right?
Mike Baines, and he was at Wells, and for a brief stint, he was a district manager. He was kind of overseeing our group, and then he left.
Okay, so you and Mike actually met. Were you directly reporting to him at the time?
Yeah.
Okay, so he was your direct report.
Yeah.
You were both at Wells Fargo. You were still in Ohio. He was still in Maryland, but his territory was one in which he probably managed multiple states.
Yep.
Okay.
Yep. And so just like anything, we always had a great relationship. And when Wells became just so bureaucratic for me, I had always stayed in touch with him, and he was like, here's an opportunity. We're going to try to build out this, retail mortgage division for this bank. You want to do it?
Had you always been entrepreneurial? Like looking back at yourself in middle school, high school, did you have that entrepreneurial spirit or that itch to go, blaze your own path and be motivated by money? Was that a part of your DNA growing up?
Yeah, it's a good question. I don't know. I was definitely a calculated risk taker.
Okay.
I kind of wanted to chart my own course, and yet though I never was like, I'm going to be an entrepreneur one day. Like my mom's an entrepreneur. She was a realtor, turned real estate attorney, and owned a title company. That's how I got even remotely even knowledgeable about real estate growing up. So I don't know if there's a complete parallel. It
wasn't foreign to you.
I just didn't at Wells. I wanted to get to a place where it was less bureaucratic. I didn't have to move up the ladder and move to San Francisco or Des Moines, Iowa. I just wasn't going to do that. So Mike was like, let's do this. I was like, we got to do it in Columbus if that's cool. Because I had just like gotten married, and it's 2008. And
2008?
Yeah, I think it was like maybe late 2007. It was 2 weeks or so before Freddie Mac stopped buying loans, and then the whole crisis happened.
So I love this because I'm a huge proponent of this Mark Twain quote, which is like, history doesn't repeat itself, but it rhymes. And I always look for patterns in business because I think if we find the patterns and we follow those patterns, that, there's ultimately is going to lead us back to success. And one would think 2008 would be a bad time for a new venture to be launched. Or one could say it was the best time because you had nothing to lose, because it was only one way up, or one direction, and that direction was up. But one way or the other, you and Mike Baines decided this was a good idea, that he was going to go work for this bank. This bank wanted to launch a mortgage division, and you were going to be the guy that helped launch that mortgage division.
Yeah, they weren't. I think they were just looking as a worst case scenario. I didn't do well.
Yeah.
It's when you're. I was always just a really hard grinder. Like, I have vision. I could say, this is where we're going to go build, and then stair step the way to build it. And that hasn't changed. It's just, but at that time it was really weird. It was probably the greatest time because you had a bunch of part-timers that were making a bunch of money. And as soon as the going gets tough, they all got washed out, and it let, a lot of less competition in for me to build. And that's what we did. And so we built, Mike and I really at American Bank built from 2008 to 2013, and we're doing great. I mean, we really had, a lot of influence and control. But
so did you start literally from scratch? Like, you were funding zero in mortgage volume, and then by 2013, do you remember where was your volume or your units? Because back then, by the way, loan sizes were half of what they were today. So sometimes I really like to talk units more than I do volume, because units really tells me how successful someone's becoming at generating leads and actually closing loans. But do you have an idea of from late 8 all the way to 13-ish, what that growth looked like?
I mean, I think I don't know at the total bank. I think the bank was doing some loans, but just not like, we were one of the first kind of like quote unquote retail P&L branches. Okay. Like, whatever, I didn't know what that was called at the time, but apparently
back then we called them net branches. You were almost probably a net branch of the bank. But so by 2013, what did you build it out to do? Like, what were y'all doing?
And we were doing billions. I don't know exactly.
Wow.
Yeah.
Billions.
Billions. Yeah.
Yeah. So that's, and I say that because,
we were best place to work everywhere. I mean, we were out kicking the coverage of the support the bank was giving us. We weren't Fannie Direct. We weren't anything. The board really, was focused on banking there. And if you're a small bank, it's very hard to survive. No different than a small mortgage company over the last couple of years. Mm-hmm. So they had to move into a place to position the company to sell. And a lot of banks, mortgage is a great like income generator for banks. And yet though, it's very complicated, and it's just one of 15 different ways to monetize at a bank. And so it was never necessarily the primary focus. I mean, we did a great job. I mean, Mike's leadership, great. But at the end of the day, they weren't going to invest into us. So that was part of the problem.
What name were you all operating under back then? What was was it the same name that you operate under today, or was it a different name?
No, it was American Bank.
American Bank. So you're operating as American Bank all the way till 2013. You basically grew it from virtually non-existence to doing billions in volume. Probably made several mistakes along the way, learned a ton along the way. And by 2013, I think where you're going is the bank ended up selling.
I mean, there was just they were going to try to position to sell, the buyer maybe not want the mortgage, and
which is common, by the way. I mean, it's very common. Like, having worked for a independent mortgage bank that was owned by a legitimate bank, right? Like, we are an independent mortgage banker, but we were owned by a bank. Like, the one thing that I always knew is it would take a very unique company to want to come in to purchase us, because a lot of banks don't want mortgage, and a lot of mortgage companies can't afford to pay what a bank is worth. So I always knew, working at my previous employer, if we were ever to sell, it was going to be to someone like a Flagstar or a Wintrust, a company that would want both a banking operation and a mortgage operation. So you're at American Bank running your mortgage, and they're trying to sell the bank, but they're having a hard time unloading the bank with mortgage being attached.
Yeah, I mean, I was just focused on our team and, innovating and driving new, things forward for the team. And when your company doesn't support that becomes a big problem. If they don't have an equal or greater vision than you do, that becomes a big problem. And I think it's okay. I mean, I think that if you're a top LO and the owner at your company doesn't want to be the top company, then you're going to have a ceiling at some point. Mm-hmm. It's just what it is. I mean, I saw that from my mom's small business. She was a incredible operator of her title business. They were big partners with Keller Williams offices, but she wasn't trying to take on a multi-state agency and do all these things. And I would ask her, why not? She's like, I just don't want to do it.
Yeah.
And so if you are there at Village Title, shout out Village, if you're at Village Title in Akron, Ohio, and you were looking for this crazy career path to expand nationally, you were never going to get it.
Yeah.
So you would have to move. So Mike and I end up starting HomeSide.
Okay.
2014.
This was about 2014.
2014.
Did you have to buy your way out? Were you able to take your entire team?
It's interesting. We didn't take our entire team. We took a very, very small portion of the team. In fact, It caused a rift because, a lot of people wanted to go with us.
Okay.
But, we had obligations and agreements. We had a really good mutual agreement with some of the leaders at the bank that, we had an open conversation with them, mm-hmm. which I think is probably pretty fair. I mean, instead of getting tied up into legal battles, we made sure that they still had an operating business that they wanted. Maybe it wasn't going to be as big as we wanted it, but it was still operating. And then we had some key folks, many are still with us today, that took the chance and joined with us to start HomeSide.
So you started HomeSide in 2014. And we fast forward in 2024, and now it's not just HomeSide, right? HomeSide is operating as Lower. Lower has purchased Thrive.
Well, you want to talk about the name game really quick.
Yes.
We started as AmeriHome.
Oh, I love this story. Okay, go ahead.
And it's one of those things where you're like, okay, how do you name a company? And I like this stuff. I like creative branding, so I'm like, let me take this. And also, shout out I had 3 other co-founders. I had 4 co-founders.
Okay.
Which
so
really,
it was you, it was Mike Baines,
it was
and then
Bob Tyson, Chris Miller, Grayson Haynes.
Okay.
Bob
Senior.
Bob Senior.
Okay.
Super experienced.
Yeah.
All these guys, so experienced. And so it was really, most would argue that it's hard to have one partner, let alone 4 other partners. And yet, though, we were all such a good mix of different beliefs. I had a little bit of consumer direct background, plus I like modern tech, etc. Grayson, Chris, deep retail, deep retail experience. Same thing with Bob Tyson, but he also had a lot of operations and was just the
secondary, I'm sure.
Yeah, then Mike is just all around. He could do sales to finance, anything else. So it was good banter. It's what led us to the success we've had today. We are a multi-channel because of that reason today. Where a lot of, which I think is the truth, which where you should be positioned, and we can get to that in a minute, but we wouldn't be there without a real balanced partnership. So we started with that group, and we all brought on a few key people and just grew it from there. So we grew it from 2014, very humble beginnings, putting IKEA tables together. And
it started as AmeriHome, which is a funny story, and
we
won't bore people with this one, but I'll fast forward through it. One of the largest aggregators, aggregators who independent mortgage banks sell loans to. That's Guaranteed Rate, Cross Country, Waterstone, Fairway, Guild, Lower. We deliver loans in the secondary market to aggregators. Could be PennyMac, it could be Planet, could be NewRez, could be AmeriHome. So AmeriHome is one of the largest aggregators and servicers of mortgages, and you once had a mortgage company with the same name.
We started with AmeriHome. We bought AmeriHome.com for $20,000. And it was a big expense. It was like getting that initial vote with my partners to say, like, okay, let's spend our really small nest egg on a domain name was a hard one. But we started it. Within 3 months, their exec team at the AmeriHome aggregators, everyone knows, called us and was like, whoa, we need to sort this out. Well, they didn't really have a right. They had just started too. It was just kind of a, hey, like we had trademarks in certain states, they didn't. So we worked out where they bought us. I don't think it's disclosed more than $20,000.
Okay.
A lot more.
Yeah.
So they're like, we'll sell you the domain. We'll get off. We got more money to help bootstrap the company. The only problem though is we had to rebrand our company within 90 days of just starting the company.
So you founded the company as AmeriHome. You dropped $20,000 on a domain just to turn around and 90 plus days later,
$5,000 on a logo. Back in the day,
have someone else want that same domain name. Yet you were able to take your lemons, turn them into lemonade.
Well, I knew that the new name had to start with an A or an H because we weren't going to redo the logo. So
get out of town.
Yeah, so our HomeSide logo was originally the AmeriHome logo. This is like an A and an H, an H and an A. It's like a house. Whatever. That just goes to show you that there's no name that's going to go get you business. It's all about you getting yourself business. Yeah. So we were like, okay, let's roll with this. And then ultimately, we launched a full-on, direct-to-consumer division.
Under HomeSide.
Yeah, under HomeSide.
Yeah, because you were HomeSide, right? It still is very much like a Maryland company with headquarters in Columbus, Ohio. And then you were, at the time of launching HomeSide, were you primarily retail or were you a true combo of retail and consumer direct?
Yeah, I mean, we were at what part?
Like at conception, like at 2014 to 2018.
Yeah, we had a small, consumer direct of inside. And then we had, a couple different branches. And we started thinking about how could we interact better together. And we slowly grew the online a bit, or the direct consumer a bit, and then also really focused on retail growth, though. That was really what we did.
Okay.
So
then where does the lower name come into play?
Well, in heading into 2019, here we are. We've gone from myself, my 4 co-founders, 12 people in like a shoebox, and we've built a top 50 company by 2017 into 18. And, I started talking to, a bunch of my, successful CEO friends.
Okay. Because you all go to the same clubs together, probably.
Yeah.
You all vacation together.
Yeah.
And, have a special handshake. I know how it goes.
Yeah. And, they had said, they're like, well, I'm like, how do I go raise money? Because we really want to go, invest in our team, invest in people.
So you knew in 2018 you had this vision and you wanted to put juice behind that vision.
Yeah.
Okay. What was that vision in 2018? And does it look similar to the vision in 2024? Or has it changed when you
I don't think
try
it's
to
changed
compare?
since 2014.
No way.
Yeah. I mean, I think we've always thought about building, if we could build a company that we, as all originators, enjoyed going to work for and could trust our clients with, we could build something pretty great.
Yeah.
And durable over the long term.
Did all 6 of you start in originating or at least have experience in originating? Can you remember?
5 of us.
5. Wow.
5 guys.
That's awesome. So you're very much a mortgage company built by loan originators for loan originators.
Yeah.
Right?
Yeah.
I mean, you could say that wholeheartedly about whether you call it HomeSide or whether you call it Lower or one of the other brands that you may operate out of. The core founders, 5 out of the 6. I don't think many companies can say
5.
that. What? 5, there's 6 founders, 5 of you originated.
No, 5 founders.
5 founders. Okay, so 4 out of the 5.
Yeah, but Mike originated.
Okay, so we put all 5 in there.
Oh, yeah. 100%.
All right. Yeah,
he
so-
wouldn't want to be. Yeah, he's definitely originated.
We can't outcast Mike. I mean,
He's probably
he'll get sad.
No, so okay, so let's unpack this. From AmeriHome to HomeSide, we launched Lower alongside HomeSide for 2 reasons.
Okay, so they were same company, 2 brands.
Yeah.
you were trying to differentiate, I'm assuming, one retail and one that's more online lead gen.
Yeah, exactly.
And you wanted your online lead gen to have its own domain and its own brand, and that brand was going to be lower.com.
Yeah.
HomeSide was very much retail, boots on the ground, subject matter experts in the community, generating leads from referral sources such as realtors, builders, financial advisors, etc.
Yeah.
Okay. But the vision in 2014, that was part of the vision.
Yeah.
You were going to do offline or old school, tried and true, but you were going to blend in online, new school, and create this company that the whole time you knew you wanted to go national with it. It wasn't going to be a regional player. It was going to be a national player.
Yeah. I mean, look, when you first start anything, you're just like, how could we make enough money to pay the bills? How can we just be successful? Can we put some points on the board? And I think that's the first thing.
You know what's crazy? I'm so sorry to this. There are so many originators who are tuning in right now, and they're like, damn, that's me. And it's a gentle reminder that it's all of us. Regardless of where you are in your career, we all have those moments and those seasons, whether you're a founder CEO or you're a rookie originator licensed 3 hours ago, where you're like, okay, how am I going to rub two nickels together to make a quarter so that I can live another day?
So you said a quote earlier. I'll say a quote now. I think it was a Ralph Waldo Emerson, my old leadership coach. He used to talk about this all the time. That our greatest want in life is to have someone make us do what we can. That's it. Just what can you do? And that's just the mantra. It's like, how far can we go until we can't? And, it's a good way. It's a good long-term thinking. I think it helps inform investments. It helps inform career paths. It helps inform making sure that we as, whether it's the founder or the exec team or the leadership, that we're not making really short-term decisions, because that affects the LOs. That affects I wouldn't have wanted that as an LO. That means that you may not be willing to invest in my realtor partnership. You might not be willing to take the risk at a new market if I wanted to expand. And, to me, that's not who we are. We're not okay with the status quo. It doesn't mean that you can't work here and be okay with status quo. It's just saying that from our perspective, we're trying to rise it up.
Yeah.
And that's just how we've been. So from 2014,
it's like be the change you seek.
Yes, exactly. Yeah, so that's it. And then,
so was it 2018 that you were having your secret handshakes with your secret clubs with other CEOs, and you're like, hey, how do I raise money?
Yeah.
Because you want to put some gasoline on this fire. You lit the fire in 2014. The vision was there. Was it 2018 that you started figuring out how to raise money?
No, the feedback was, it's going to be really, of course you get feedback, and it's now looking back, a lot of it was just BS. But you don't know what you don't know. I mean, I tried to do the best to navigate it, but it was, it's going to be really hard to raise money with a company or a brand that's 7 years old. So we had started in 14. Now it's, 18, whatever that is, 4 years.
Yep.
So 4 or 5 years. And that was back in the time where everyone wanted, the investments were going into the new age companies. That's not true. I'll get to the why in a minute. But they were like, so I'm like, what do you mean? Like, you need to have a new company. Well, that's really difficult in mortgage. No, I didn't want another company. So we did what I thought. I was like, went into my brand team. I go, we're going to create a completely separate brand, and it's going to focus on direct to consumer and online. And I need names by Monday. It was like a Friday. And the team came back and they had this whole list of 8 names, and Lower was one of them. And I'm like, oh, that works for everybody.
Yeah.
Like, if you can get the domain, I'm in. And that to get lower.com was huge because, even like that is a big thing for recall. If you're in your local realtor office, and I can say, hey, it's Dan at lower.com versus, hey, it's Dan at HomeSideFinancial.com. It's just easier to remember. Plus, I think it resonated, and what we wanted to do was just drive good value for good service. Anyway, we get it. We lock it in. It becomes Lower. So now we're operating kind of HomeSide retail and lower direct to consumer. And in 2019 into 2020, we continue to just do what we're doing across all channels. We're successful. And, I end up talking to as many people as I can about what we're doing, and not going on like a money raising roadshow, but just asking other entrepreneurs, like, how did you raise money? Mm-hmm. And I stumbled upon a guy named Clay Wilkes, who is the founder of a company called Galileo, which is like very, very they sold their company for, I think he sold his company for $1.2 billion to SoFi.
With a B.
With a B.
Okay.
And he was the majority owner. And he was like, man, your company's great. You should go talk to Excel. And if you can get through, if you can get some meetings with them, and they're like, that'd be a great company. And, I ended up talking to our now investor, and,
You shot your shot. Were they already in banking? Was Excel already in banking?
No. And
because I would like to believe I'm a student of our industry. Like, I'm passionate about our industry. I think that comes across with most of my podcast episodes. And it's rare for me to get to know a founder's story and have venture capital money, especially at a Silicon Valley, come into mortgage.
Yeah, our industry is difficult to raise money, and because of the cyclical nature of it, because of it's just overall dynamics.
It's complexity, it's regulation, it's boom bust. Yes.
Very transactional, all these things. I think looking back, okay, how did we raise money? First, we had big ambitions. Like, we didn't go in thinking that we were going to be, we're like, this is how we're going to do it. Here's how we're going to innovate. Here's where we'll use the money. Like, we're going to build technology. We're going to, we already have a great culture, and, we really feel like there should be a competitor to the guys up north, like in Rocket.
Yeah.
I mean, like, honestly, and it's, say what you will, but I mean, Rocket operates an incredible direct consumer outfit. They got a great wholesale outfit. They have a very multi-dimensional company, and yet though, they win really good service awards, they do good, they're worth $50 billion. So that's a pretty good comp.
Yeah, you're like, why not us? Why not now? Even if it's in our own flavor.
Yeah.
We don't have to be the next Rocky. You can still be the next lower, but those guys up north have shown that there is a way.
Yeah.
If you just had the right financing and possibly the right bandwidth.
That's exactly right. We weren't, they in fact didn't want us to be exactly like Rocket, obviously.
Yes.
They liked our idea of, promoting boots on the ground that were W-2 employees, not just brokers, that we can support, and also an online, capability. So anyway, long story short, I think the fundamental how do we raise money is because we had a really, really good company.
Yeah.
We had a really good team. I mean, we were always growing top line, always growing bottom line. Since 2014 to the time we raised money, it was always up. And we were winning Best Place to Work awards, and our team was giving good feedback. We had 50,000 five-star Zillow reviews. Number one lender on Trustpilot. It was just layered on. And I think that, looking back, is really the winning sauce. When people ask me, like, how do I raise money? I'm like, you gotta have a great company, especially if you're gonna raise money from the best. Now, little did I know, as soon as we raised money, the whole market would fall off.
Yeah.
Which was kind of...
Such is life. Such is life.
But
yeah.
Man, I mean, it was good timing for us.
Good timing because you're well capitalized.
Yeah.
Good timing because it brought you opportunities to purchase some volume, possibly at a discount.
Yeah, I mean,
or at least at a fair market value.
Yeah, I mean that for sure, and brought on really good talent, and we were able to stay in the game at a high level. It separated us dramatically.
Yeah, because in the past year or two, you had an acquisition of Thrive.
Yeah.
Right, and Thrive's a hell of a brand name, especially down in the Texas market. In my home state of Florida, you picked up Hamilton.
Yep.
Right, and I was always very familiar with Hamilton. Always respected the guys and girls over there. Out in Denver, you picked up Universal Lending.
Yep.
Right, TJ and his crew have been probably one of the oldest independent mortgage banks in the state of Colorado for 50 plus years.
Yeah.
Right, like you were very opportunistic. Although the bottom fell out of the market, which maybe put some detours on some of your other agenda items, it also opened up opportunity to do what you're doing. How do you see, Dan, how do you see the future of mortgage lending? So here we are, like we might as well say 24 is almost ready to put a bow on it. So we're going to be in the back half of the 2020s. Our buddy Amir loves to call them the roaring 20s. I don't know if I'm probably more excited about the 2030s as I am the 2020s. But looking at the back half of these roaring 20s and into 2030, what's exciting you, and how do you see the mortgage industry as a whole? And then obviously, your fit leading the ship here at Lower.
Yeah, it's a lot more fun when you're up 100% in most categories year over year, and your team is up 50, 100% year over year. So that just gives you a little bit more motivation. Now, we still have a lot of work to do. The rates aren't. I think that since the Fed lowered rates, 10-year Treasury is up 30 basis points. And that's kind of hard to explain to the consumers. It's hard to explain to investors. So dealing with that. So where are we headed? I think that you learn a lot of lessons in downturns, and so we are committed to building a durable company in the future. Committing to investing in our team, bringing that modern approach. So how do we help continue our mission of making the originator the star of the show, helping them be an influence in their market? Not everyone's a Dustin Owen, or an Amir.
Well, I would say I hope they're not me, because I'm a hot mess most days.
Well,
I'm a lot to handle.
But you get it. And so it's How do we bring that to our originators in the markets, make them the star of their markets, top 5, maybe top 1 in their market. That's our whole goal, especially on the retail side. And then on the direct-to-consumer side, how do we really provide elite level service, help customers, whether it's refinance in a few clicks, service our customers really well, and be the source of authentic content at lower.com. So these are really big kind of chunky initiatives we're working on as we go from, call it 29th largest lender in the country, 28th, 25th, whoever you're counting, it's on our way to top 5. We're never going to be a top 5 though if we don't first take care of our existing folks and bring them up to top 5. So that's every day. All I'm thinking about is how do we do that?
Yeah. I want to tell you, I don't know if you heard this or not, at least not directly from me, as an outsider, right? I'm an insider today, but I've been here for 8 weeks, right? As an outsider, what attracted me to leave a company that I loved, people that I adore, something that I literally, when I started, my group was doing 40 million a year. And like you, we built it from my last month there. We did 70 million, right? The company when I started was doing 400 million a year. We didn't even have our DE. For those that know what a DE is, let alone a Fannie or Freddie ticket, right? When I left, the company was on pace to fund about 2 or 2.5 billion, right? So that's a pretty cool growth trajectory. It was going to take a lot to get me to leave. And so I want to share with you so you can hear it from me firsthand as an outsider, what I saw. And I think what I saw is a lot of what your investors saw. Before I do, by the way, I'm not a hot mess. I know I said hot mess. I'm a lot to handle, but no, anyone who knows me would never describe me as a hot mess, because I'm pretty analytical, anal, I-dotting, T-cross. Sometimes my drive could run people over, but far from a hot mess, but I am a lot to handle. All right, so for that clarification, outsider looking in, when I go to invest in a company, which I've been fortunate enough to invest in probably a dozen or so tech startups. Usually I do angel investing, not Series A. That's for the rich people. Us small peons can do some angel investing, but we start by investing in the jockey and not the horse. Right, you have to have a nice racehorse, don't get me wrong. You have to have an idea, you have to have some kind of traction, and it has to be scalable, and preferably you've gone to revenue or you're close to going to revenue. But ultimately, I'm betting on the jockey. Right, as an outsider looking in, what did I bet on? I bet on Dan Snyder and Mike Baines. I looked at those two guys, and I said, whatever they're doing, I want to be a part of. And so then I said, well, what are they trying to do? And what first caught my attention was you sharing this story of there's online lead gen, there's offline lead gen. And we've been operating as if they're two separate silos, and they shouldn't be, right? Our online lead generators should be great at doing the things that the offline lead generators do. And our offline lead generators should start embracing online lead gen, and we should be the company that supports both and teaches both. And I was like, yes, I had been asking for this for years. I mean, even wrote a paper about it and won a competition with a very similar idea. And then I saw that you had the money to do so, because people have ideas, but they don't have money necessarily. And I'm like, damn, they got some coin. Okay. So I have a couple good jockeys. They have great vision. They have some money, but what are the people like? And I'm like, wow, they're all pretty awesome. And then we're onboarding awesome people to go with the already awesome people who are here. And it's like, and we're building out our all-star team. And it's like, we have an opportunity to look at who is already here and promote them. Like you said, promote from within. And by promote, I mean, not in title, but promote in terms of support and growth. Maybe some people get titles out of it, and maybe people get promotions out of it, but it's usually with that. But then we can attract other all-stars. Like, who are the best of the best? Who are the visionaries? Because you're right, we are not going to be a great company for all. I don't think that. I think we're going to be a great company for those that want to be a part of the 2030s, for those that want to be less of the 2010s, for those that are in growth mode. So for those that are visionaries, I think we are it. Now, I have some friends that we are not a good fit for. I have some friends that have 4 years left in their career. They're like, I'm happy with where I am. I'm happy with the money I'm making and who I'm doing it with. I'm like, yeah, probably not a good fit. Unless that company starts screwing up, right? But if your company's doing a decent job and they're not screwing up, obviously if your company's screwing up, give us a call, But as an outsider looking in, that's what attracted me.
Yeah,
and still today, it's what I get excited about.
Yeah, like the grass is greener where you water it in almost all cases.
To a degree, but it depends on the type of grass you're trying to grow.
Exactly. I mean, unless you just have to understand, like, if you're a loan officer, you're good with $12 million a year, $24 million a year, $50 million a year, $100 million a year. I mean, I just had dinner with Shant at the
Shout
housing
out to
market.
Shant. Shant's he's a fan of the show. He's been a guest on the show. I was just with Shant actually in New England, but yeah. So you and Shant were at dinner together, probably at the IMB Summit, right?
Yeah,
Housing Wire event.
Yeah, so if he was at a smaller lender, he would eat that lender alive. You have to align with where you want to be. I mean, he's doing $1 billion. I mean, I think that he's like, yeah, I just launched non-QM programs. So he's like, I think there's a huge opportunity. And I asked, like, how much is that you doing? He said 10%, like $100 million a year. I'm like, geez.
Yeah. I mean,
100.
he's on pace. I think he does like 100 units a month. His team does. He's a big team, but still, he runs the show there. Like, his personal production is the size of a top 100 IMB.
Yeah. So I think that you join or you invest because you've done some self-assessment. Like, what do we want? In terms of Excel, they wanted to be in the housing and mortgage finance space. It's if anything, it might be the largest asset class in the United States.
Yeah.
Is it risky in some cases? Sure, but bet on a company that's been doing it and has aspirations to do it and continue to keep adapting. And that's what Mike and I are really driving towards is, okay, we just because we did it one way to begin with doesn't mean we don't have our eyes open and continue to keep adapting. Bring on good talent to mix with our good talent.
Yes.
Like these are things that are just recipes for, attracting, whether it's the Dustin Owens or it's, the next.
Yeah.
I mean, and yet you're right. It's not going to be a fit for everybody. But I think that's just what it is. We're just happy to be in the conversation and we are happy to get the opportunities. If we get opportunities, we can take it from there.
I love something you said earlier. It's wanting to become a top 5 lender, right? That means I'm with a growth-minded company because we're somewhere around 29 right now, right? So we want to become top 5. Nowhere in there did you say top 1, like number 1, right? Because sometimes that can be a goal that is almost punitive, right? It doesn't help the bottom line and it could ruin your culture. But it's what you said behind it. We will become top 5 only if we help the individuals in the local markets become top 5 or top 3 or even number 1, right? So it's not all about we are going to come hell or high waters become a top 5 lender. It's like, no, we're going to focus on the markets that we're in or the markets we're expanding on, helping those individuals and those branches become top 5. And if we do that collectively from Spokane to Key West and everywhere in between, we're going to turn around and have a company that, yes, is top 5, culturally is number 1, and potentially is the staple for the 2030s because we are a lender of the future. And I think it's going to be a lot of us embracing the tried and true, but then also mixing it with the new, especially with everything technology is going to do. That wasn't supposed to rhyme. Amir's the rhymer. Like, he likes to do the sing-song, rhyme time. I'm not that creative. I'm a pretty creative person. I'm not that creative. So last 2 questions I have for you, because at some point we have to put a bow on this. At some point we'll lose the audience's attention. You and I could probably sit here and go another hour or two. I want you to do us a favor, and us may just be me, but looking back and talking to Dan when he's 33 years old and he's starting HomeSide, what couple words of wisdom would you share with that version of you? Whether it's hey, do more of this and do less of that. What would you tell that guy?
That's a good question. It's it'll all be okay.
It'll all be okay.
Probably, yeah.
Yeah.
Because it's so scary at times.
Okay.
It really is. I mean, it's like, in the highs or the lows, because, you're trying to do the best you can for your team, but, it's all of a sudden transitory inflation becomes real inflation. All of a sudden, someone getting sick becomes a global pandemic. And you just have to deal with it. And so I think everything always works out the way it should, as long as you're persistent. And like that's, you have to, that's it. So I'd say, hey, look, it's going to be okay.
I will tell you, that's probably one of my favorite answers ever of a guest. And I love it because A, you were vulnerable, but B, you just shared with tens of thousands of people who probably look at you and like, oh, Dan, he has all the answers. He has the world by the horns. And you're like, nah, I'm a human just like you. And I have my own fears and anxieties and worries. And it's like, it's okay if they do too. Just remind yourself that it's all going to work out. And, just stick to the plan.
Yeah, I mean, the key is not to not keep moving. I mean, if you're on a drought, you have no loans in your pipeline, no different than, I've had that like at large scales, whether it's you've got a group leaving you didn't want once, or if you have, you run a marketing campaign and you spend your entire budget and nothing comes in, no leads are there, and you can't put food on the table like that. Like, I'm not immune to that at all. Mike's not immune to that. The key though is worrying about it or think like you've got to move on. You got to keep moving and moving and moving and just put, I say this all the time, you have to continue to put points on the board. Strategy doesn't matter, but production matters. That's it.
Fast forward, and I may have already answered this or you've already answered this, but fast forward 10 years, right? So now you're in your early 50s. Where are you at? What are you doing? What does the company look like?
No, I think that, if I'm capable, I'll still be, leading it. And same thing with Mike. If I'm, knock on wood, health wise, but I'm going to continue to keep leveling myself up as CEO, like reading and listening to our team, and talking to others about how I can get better. No different than I did 10 years ago, when I wasn't really. I mean, it's so I'll keep leveling up, keep pushing forward, and my hope is that our team and those, whether current and or future, really help take us to the next level for our customers, for our realtors, for our for our new employees and beyond. Honestly, like it's hopefully we have a little bit more favorable, stable market. So we don't.
Fingers crossed on that one. We're due. We're due a nice 5-year run.
Just stable.
Like
I want 2019 for years.
I've said over and over, just give me like 2014 to 2019. Like, give me that run.
Except for 2018.
18 sucked, but I learned some valuable lessons. The first time in my career I had to cut $1 million out of my budget. And that wasn't so I could make money. That's literally so I could survive the year so I could survive 2019.
Right.
So yes.
That's why 2019 was so good, because everyone had to cut everything in 2018 Q4. And then I think they were like, the Fed didn't do what they did in 2019. It was a great year. But look, I think that, God willing, we're, a successful company and people want to come work here. Like, that's really what we're built around. And we're not going to keep, we're going to keep pushing the status quo and keep adapting.
Are you easy to connect with? Are you a LinkedIn guy? Like, if someone
Yeah,
wanted to connect
LinkedIn,
with
hit
you,
me up.
First name Dan, last name Snyder, Snyder, but he's not that Dan Snyder. He's the younger, cooler, hipper version. Hey, look, he's Dan Snyder. I'm Dustin Owen. You've just tuned in to Loan Officer Podcast. Quick shout out to our sponsor, Open Door. Thank you again. Much love. Shout out to Lower. Here we are up in Columbus, Ohio for the annual sales conference. I'm excited to spend some time with you, Dan, but unfortunately for these people, that's all the time we have for you today, but we do look forward to catching you on the next episode.
Thank you.
Peace.